settled into the house. Now that you have a home, what's next? On this week's Emily Now episode, we're going to be talking about mortgages for rental properties, getting a mortgage for a second home like a vacation property or a home for one of your children. I'm going to walk you through an example of someone that took advantage of a second home. They've got a condo in the city and a cabin on the lake, and an article that ran in the Globe and Mail here recently about not rushing to pay off your mortgage and some things to think about. So we hope you enjoy this episode. Stay tuned. My name is Dylan Gallagher, founder of mlenow.ca. mlenow.ca is an online platform where individuals and businesses can get prepared for the mortgage or loan that they're looking for. I've been working in this business for about 18 years, almost 20 years actually, helping people and businesses get the money that they need. Each week we put together this Emily Now episode with a focus on finance and a particular highlight around debt, including mortgages and loans, because we want to educate you. We want you to be in a position to make better decisions about the money that you're going to borrow. And the reason we think that's important is because if you can make better decisions, you'll probably end up saving money, maybe investing in the future, in future opportunities, or giving back to the community around you. And in our little way, we hope that these Emily episodes give you the knowledge you need to be able to do that. Before we get started, wanted to let you know that you can follow us on Emily Now Canada. That's at Twitter. You can like us on Facebook. You can subscribe to us on YouTube. You can find us on Google+. I mean, we're not trying to be everywhere, but we're in the places that matter. And so we hope that you would look us up, that you'd connect with us, send us your questions. We've got a great team of people here that would love to interact with you and would encourage you to jump on at mlenow.ca if you think you need a mortgage or a loan. With every episode, we start with a few questions that we either saw come in through our social channels or that we picked up through the different client interactions that we're having. And so the first question for today is, how can I get a mortgage for a rental property? After you've purchased your primary home, many people begin to consider investment properties. And so we thought it would be important today to talk about a few things that you need to know if you're looking to get a mortgage for an investment property. And so the first thing that you need to know is your down payment has to be at least 20%. So whatever the purchase price is of the property that you're looking to purchase, the down payment that you're going to need has to be 20% of that purchase price. You're also going to want to know how much rent you will earn compared to the mortgage. In a perfect world, of course, the rent that you end up collecting from a property is going to not only pay the mortgage, but it's also going to provide you with a little bit of extra cash so that over time, someone else has been paying off the mortgage, maybe the property value has gone up, and that's kind of the general rule around why people buy investment properties. But banks oftentimes are going to get an appraisal on that property to confirm how much rent you can actually earn on that property. And so here's something that you really need to know about rental properties and the income. Many times someone will sell a property and they're going to say, look, I'm selling this property, we make $2,500 a month, and therefore with a mortgage payment of $1,800, this is a really good investment property. And you think, wow, yeah, it is. And you and your realtor, you go out and you make an offer only to get to the bank, and the bank says, well, it's great that the property makes $2,500, but we've got this appraisal here. And this appraisal says that on average, rent is actually $1,900 a month. So you know what? That's the number that we're going to use as we process your application. And so just because you see that a property currently earns a certain amount of rental income, keep in mind that when you go to the bank and talk to them about getting a mortgage for that property, that the bank is actually going to get an average of the marketplace or the community that your property is in, and that can have an impact on your mortgage. Some other things that you need to know if you're looking at getting a mortgage for an investment property would be that many banks and lenders will have a limit on how many investment properties that you can actually have. So it used to be back in the good old days that banks would just keep giving you mortgages as long as your credit was good, your credit score was good, and you had enough income and some net worth. But now it's pretty frequent that banks will say, look, we only want to finance 2 investment properties or 4 investment properties, or some banks will even go the other way and say, if you've got 4 or 5 properties, we don't want to lend to you. We don't want to give you any more money for any investment properties. You might have to find a different lender for that. If you currently have a rental property and you go to purchase another property, and the bank is going through their due diligence and trying to figure out whether or not they can approve you, one of the things they're going to check for is that you're actually claiming the rental income from the first property that you have. And you think, well, yeah, Dylan, doesn't everybody do that? And the answer is no. In fact, it's quite frequent that people who have a rental property, if they only have one, usually they don't claim the rental income at all. But the problem that presents is when they then go to apply for a mortgage on the second rental property, the bank says, okay, well, your primary residence will use your employment income to show that you can make the payments on that one. Your other rental property that you have, we want to see the rental income making the mortgage payments on that one. And so the way we do that is we want to look at your tax return and make sure that you're claiming the income. And many times people just simply aren't doing that. So know that if you're buying your first rental property, make sure that you do it properly, that you do claim the income, that you work with a great accountant who can help you make sure that you're maximizing the tax credits for expenses, and that it does show up somewhere on the radar, so that if you go to get money in the future, you can show the bank that, look, I've been doing everything I should be doing, I'm claiming the income, and the bank shouldn't have any problems with that. One of the last things we just want to mention on this topic of getting a mortgage for a rental property is that many times people will say, can I put, for tax reasons, my accountant says I need to put these rental properties in a company, in the name of a company. And so that's fine. For tax reasons, that makes a lot of sense. But for the bank's purposes, many times banks won't let you do that. And if they do let you put it in the name of a company, Dillon Investments or a management company of some sort, they will say, look, the company can be on title, but you, the individual, need to still sign the guarantee and be responsible for the mortgage. So if something goes wrong, if the mortgage goes into default, we're not going after the company, we're going to go after you. So make sure that if you are trying to structure a deal where you're going to put a rental property in a company, that you are working with a specialist, with us, or with a bank that is able to actually help you do that. So that's something to keep in mind. And if you're interested in purchasing an investment property or another investment property and you want a mortgage for it, we'd encourage you to visit us at mlenow.ca, where you can get an Emily score that will sort of rank your information out of 10. It takes less than 5 minutes to do, but it'll give you a really good idea of what you're going to need to do to get approved, the interest rates that you would qualify for, as well as the banks that will take a look at your application. And so from there, you can get our help, we can help you get approved, or you can send your information through mlenow.ca directly to the bank. It's free, doesn't cost you anything, and we have an amazing client services team that's here to help you in the event that you do need help. So moving right along to our second question. Today, the second question is, how is getting a mortgage for a second home different than getting a mortgage for my first home? So real quick, a second home is loosely defined as a vacation property or a property for another family member. But it's basically a second property that you own, but you will not earn income or rent from it. Getting a mortgage for a second home is considerably different than getting a mortgage for your first home or your primary home, mostly because you're going to require a larger down payment. For your first home, you can get mortgage insurance and you can buy a property with as little as 5% down. But on your second home, you need to have at least 20% as a down payment. So you need a big chunk of cash in order to purchase a second home. And that's usually different than buying your first home, because most people will take advantage of mortgage insurance and try to buy their first home with a very small down payment. As well, for second homes, you're going to have more income to show the bank than what you had for your first home, and that's because the bank wants to see that you can afford your primary home, and they want to make sure that you can afford the second home that you're looking at buying, whether that's a cabin on the lake or whether that's a home for one of your children. And this is because you've got to be able to show you can make 2 payments. But with a second home, unlike, say, purchasing a rental property, the bank will not allow any other rental income to be included in the equation. So if you're buying a home for your child, or you're buying a cabin on the lake, you're not going to be able to show that you're renting that property out and making income, which the bank can add to your income to show that you can make the payment. So that's a little bit different than when you buy your first home. And as a side note, most people don't know this, but if your primary home has CMHC insurance on it, let's say you have some children and the home that you currently own right now, you had 10% or 15%, you put it down and you got CMHC insurance on your home. If your child now wants to go out and purchase a home with 5 or 10% down, but they need you to co-sign, that's not going to happen. The rules have changed recently where if you're co-signing for a child that's going to need CMHC insurance because they don't have enough down payment, but you already have CMHC insurance on your own property, then you can't be a co-signer for that mortgage. So that's something that's a little bit different that you need to keep in mind. Getting a mortgage for a second property doesn't have to be tough. Some of the things maybe I've just shared with you would cause you to go, oh, maybe we need to rethink this. But I would encourage you, visit mlenow.ca, register for an account, punch in some of your information, and you're going to be able to see the paperwork, the math that the bank is going to use. But more importantly, we've got a live chat service. We have an excellent customer service team that's going to be here to help you. And so if you are looking at purchasing a vacation property, or you're trying to help your child purchase a home, or you're buying a home for another family member, get in touch with us and let us help you do that. Again, service is free, doesn't cost anything, but you might be surprised in what you learn, and you might be surprised in what you're able to do. I'm going to show you guys today some of the things that can go wrong, some of the things that can go right, but basically it's going to encapsulate some of the things we've been talking about on this week's Emily Now episode. And this is for a commission salesperson who purchased a downtown condo in the early 2000s, and life was pretty good right up and until kind of 2006, 2007, the peak of the market, and earned some great commission income, and took it, and he bought a cabin on the lake. And recently came through mlenow.ca because he needed to pay out some financing on the cabin that he had bought. And you would say, well, why did he need to pay out that financing? Well, it turns out when he bought the cabin, he ended up getting a first mortgage and a second mortgage because his credit wasn't quite where he needed it to be. He had some credit problems in his past that, when he went to the bank and said, look, I want to buy a second property, the bank says, well, your credit kind of doesn't fit the bar. So instead of giving you all the money that you're asking for, we're only going to give you some of it. And then he went and got a second mortgage at higher interest rates. Now, he ended up coming through mlenow.ca because he thought, well, maybe I can refinance my condo in downtown, my downtown condo, and take out some of that money and pay off the second mortgage. So we were able to do that for him. But a couple of things that come out in this is, first of all, if you are going to buy a second property, a cabin on the lake or a vacation property of some sort, you've got to make sure that you have a plan. And in this particular case, during the best earning years that this particular individual had, he didn't bother paying off his mortgage outside of the normal payment. So just as a refresher, most times when you make a mortgage payment, a little bit goes to principal, a little tiny bit, and a lot goes to interest. And so even if you have a mortgage for 5 years, you'll find that the principal amount that you end up paying off isn't as much as it could be. So in this case, instead of using his really good earning years to pay off the mortgage, he ended up spending the money on other things. And so when his earnings slowed down a little bit and the economy changed, he was really finding it tough to go to the bank now and try to renew his mortgage when the mortgage term came up. So if you're going to have a second property, and if you expect that things in the economy might change your earning potential, you're going to want to pay off your mortgage. In this case, the reason this particular individual was able to pull off what he was talking about was because he was really, really fortunate. The downtown condo, the property value had actually risen. So when we went to go and do the refinance for him, he was able to take out some equity that he had built up because of the market value increasing, and was able to take that equity and then use it to pay off the second mortgage on the cabin. Now some people would say, well, that sounds like a pretty smart guy. Yeah, maybe, but what if the market value of the condo didn't go up? And not only what if it didn't go up, what if it just stayed sort of flat? Then that means the second mortgage, the term had come due, and he may have been facing foreclosure. Even though the second mortgage was up to date, that particular lender who was doing second mortgages said, look, we're not in the business of doing these types of properties anymore. We don't want to do cabins and vacation properties, so we'd like our money back. So he was in a position where he had to figure out how he was going to take care of this. And for you, if you're looking at buying a cabin or a vacation property, make sure you have a plan. Make sure that you know you can make the payments, have a backup plan if you can't, but more importantly, make sure you're paying down your mortgage over the term. And again, if you're looking at getting a cabin on the lake or a cabin in the woods or a cabin on the beach, you can visit mlenow.ca and get started on putting your information together and figuring out how you can get approved. It'll take you less than 5 minutes. You can get an Emily score out of 10, which you can then use to see what the interest rates are going to be, what the banks, who the banks are that would actually approve your request, and then you can have us get you approved, or you can approve yourself by sending your information directly to the bank. So we, of course, would encourage you to do that. There was an article that ran in the Globe and Mail that we picked up that we thought was important to share, which fits the episode that we're recording today for people that own properties and now are looking at maybe acquiring more properties. And the theme was not rushing to pay off your mortgage. And we thought there were some things to think about. There's been a trend developing where people appear to be more comfortable carrying debt into their retirement years. Article talks about some tax reasons for doing it, some cash flow reasons for doing it, and we thought we'd talk about what does this sort of idea mean for you if you own a home and currently have a mortgage. And one of the things that I always try to talk about, and again, I've been doing this for almost 20 years and have some very personal experiences with what happens when things don't work out, but one of the overlooked facts is that interest is a real cost. Many people think that today, because interest rates are so low that 2 or 3%, Dylan, what is that really? Well, the truth is that is real money that's going somewhere else, and it's not going to your benefit. And even if you take a mortgage over 25 years and all you do is just make the payments, and even if interest rates stayed at 3% the entire time, the reality is that over 25 years, run the math, you can try it yourself, but you end up paying for that property a few times. Whereas if you were able to, in the early years, keep your life really thin and pay off that mortgage, that's an immediate investment return. And so if your mortgage is, say the interest rate on your mortgage is 3 or 4% or 2% or whatever the interest rate is, if you pay off that mortgage and you're no longer making those monthly payments, it's as if you're earning that 3 or 4% on your money. I mean, that's the best investment you can make. In fact, if you talk to debt experts, people who work with individuals that have racked up credit card debt and find themselves in financial duress, the best investment any of those people can make is paying off their credit cards, because all they're doing is just paying interest, and that money doesn't accrue to their benefit at all. It doesn't build their future value. It doesn't build their future portfolio. So that's something to think about that I think many people forget, is that interest is actually a real cost. There's a true cost there. Another thing to consider is that many real estate properties do not increase in value over and above interest rates. Now, what does that mean? And I don't want to get a bunch of emails about this, because it depends on sort of how you take it. But generally speaking, if you look back over the 25 years that you're going to have the mortgage on your property, and you look at how much that property value went up, assuming it did, and then you look at the interest that you had to pay, what you're going to find is that the property value did not rise high enough to cover the interest of what you paid over that 25 years. Now, again, the reason it depends on when you look at that argument. In the last 10 years, there's an argument to be made in some major places in Canada that the property values did in fact spike way higher than what the interest cost would have been. But generally speaking, most people who are going to get a mortgage for 25 years, it's going to turn out that they paid for that house 1 or 2 times, and that the property value, when they finally pay off their mortgage, if they do, that their property value didn't increase enough to recover out what the interest was. And that doesn't include, by the way, all of your costs. If you have to fix your roof, if you have to fix your air conditioner, if you have to paint, put on a deck, all of the maintenance costs as well. in addition to the interest cost means that houses generally are some kind of a flat return. If you keep a mortgage and you decide, like this article sort of alludes to, that people are okay with it, they want to carry debt into their retirement years. The challenge you have, that I think one of the things to consider is that the challenge is that your investment portfolio doesn't get to grow and you don't get the compounding effect. So for example, some people will say, well, I'll just pay the mortgage at 3% and then I'll turn around and invest the money at 6%. Okay, fair enough. But many people don't have the ability to do that. Many people don't know where they can get a 6% or a 7% or a 10% return that makes carrying a mortgage for 25 years and refinancing for maybe another 10 or 15 years even worth it. So my thoughts on this are always, mortgages, like debt, are a tool to use for a period of time, but you need to have a plan. You have to know why you're getting the mortgage, how you intend on paying it back, and how you can maybe do that faster than you originally anticipated, so that one day you don't have a mortgage payment. One day, every 15th and 30th or once a month or whatever your mortgage payment schedule is, you're not watching that money go out the door. In fact, you're watching that money go into your investment portfolio, you're watching it grow, and over a period of time it will compound faster than if you simply just let your mortgage run over 25 years, make the minimum payment. Your investment portfolio doesn't grow as quickly as it could. And so these are all personal decisions. I realize that everybody has their own take on it. Everybody's going to have their own advice and their own history. But generally speaking, my philosophy has always been, certainly for the last 20 years, pay it off as quickly as you can. Don't let a lender or a bank make more interest off of you than they absolutely should based on your situation. And sometimes that might mean renting so that you can save your cash. In other times that might mean getting a mortgage but having a plan for the next 5 or 10 years to live really, really lean so that we can make our principal repayments every year. And if you want to see what's involved in getting a mortgage, if you've watched this episode and maybe you don't have one now, or maybe you do and you're looking at purchasing investment properties or trying to grow your portfolio, we'd encourage you to go to mlenow.ca. It's an online platform that you can use at no cost. Simply punch in the mortgage amount that you're looking for, answer a few questions, and it's immediately going to show you, okay, well, based on the information that you've presented, here's the interest rates that you can expect. Here are the banks and lenders that will most likely approve you. And then if you make the decision to register for an account, we'd be happy to help you. And if you don't want our help, you can send your information directly to the bank through our platform as well. So thanks for watching this week's Emily Now episode, and we look forward to seeing you next time.